Well, with the Fed's decision yesterday to raise rates by 50 basis points, now the market's trying to figure out, are they going to keep raising for 50 basis points after we heard the Fed chair take 75 off the table? Joining us now for more on the latest Fed decision is Meghan Swiber, Bank of America rate strategist. Meghan, welcome. Thanks for being here. You talk a little bit about, in your note in reaction to the Fed commentary, that we got to watch the data. But the Fed chair said you can't just watch one data point. You got to watch a bunch of them. And over a period of time, the market feels like it's going to be too twitchy for that. So how do you think we trade over the next few months?
Yeah, I mean, great questions here. So really, we heard yesterday from Powell that he basically gave us more clarity on what the Fed path looks like going forward here. He put the kibosh on a 75 basis point rate hike and really endorsed the potential for 2 more 50 basis point rate hikes, which is really consistent with what we in the market had basically been pricing coming into this meeting. But this is really a good thing because it gives the market a little bit more clarity around what to expect over the next few meetings, reduces some of the volatility that we've seen really very prominent in the front end of the Treasury curve.
Meghan, we're seeing now the markets really sell off here, really starting to give back all the gains that we saw yesterday after that Fed decision day. My question to you is this. You think this is the market realizing that this is still a hawkish Federal Reserve?
I think that's in part the point here, right? The market is under the impression that the Fed is going to be responding to inflationary pressures, right? Powell led with that, right, kind of out of the press conference yesterday, right? The Fed still needs to address these inflationary pressures. And the path from here is going to be conditional on it. He gave us some of that clarity with regard to how fast the Fed's going to deliver hikes for probably the remainder of this year. The Fed's looking to get to neutral, which is at about 2.5% on the Fed funds rate by the end of the year. But then the decision becomes next year, how high do they need to take the Fed funds rate? And that's going to be a function of really 2 things: where inflation is coming in at the end of the year and where longer-term inflation expectations are at the end of the year.
Meghan, lastly, by the end of the year, where do you think rates are?
So we expect the 10-year rate, which has been moving significantly higher on the back of some of the volatility that we've seen in the front end, to be at around 2.5%, which coincidentally is also where we expect the Fed funds rate to be at the end of the year. So we're going to be looking at very flat curves here. We think that the Fed will be bringing rates to, as I mentioned, neutral, about 2.5%. And the back end of the curve is probably going to be more anchored on where those longer-term inflation expectations are. As long as those are not becoming materially unanchored, that's going to remain around 2% or so. And also where longer-term potential growth is, which is 50 basis points. Add those 2 things together, that's 2.5%, which is what we're targeting for the 10-year rate by the end of the year.
All right, we'll leave it there for now. Meghan Swiber, Bank of America rate strategist. Good to see you.